USD index appears depressed post-Fed, breaches 101.00. The index drops to 10-month lows near 100.80. The dollar remains on the defensive post-FOMC event. Initial claims, factory orders next of note in the docket. The greenback, in terms of the USD index, DXY, adds to the weekly leg lower and breaks below the 101.00 support to print new 10-month lows on Thursday. USD index, a visit to 100.00 appears on the horizon. The index retreats for the third session in a row and maintains the 2-week negative streak well in place on the back of further deterioration of the price action around the dollar, especially following the FOMC event on February 1st. Indeed, the dollar keeps losing ground as market participants continue to assess the recent decision by the Fed to raise rates by 25 bps, the smallest hike since the beginning of the tightening cycle almost a year ago. Both the Fed statement and Powell's press conference acknowledged that inflation seems to have lost some traction, albeit it remains elevated, suggesting that the ongoing increasing rates remain appropriate and opening the door to a new normal at 25 bps. Later in the NA session, usual weekly claims are due, seconded by factory orders. Of note, in addition, will be the interest rate decisions by the ECB and the BOE, where a 50 bps rate hike appears already priced in both events. What to look for around USD? The dollar retreats further and breaks below the 101.00 support to record new multi-month lows amidst increasing selling pressure in the wake of the FOMC event on Wednesday. The idea of a probable pivot/impasse in the Fed's normalization process continues to hover around the greenback and keeps the price action around the DXY subdued for the time being. This view has been reinforced after the Fed hiked rates by 25 bps on February 1st, while speculation of the terminal rate now below 5% gathered some traction as well. Key events in the U.S. this week: initial jobless claims, factory orders, Thursday, non-farm payrolls, unemployment rate, final services PMI ISM non-manufacturing, Friday. Eminent issues on the back boiler, rising conviction of a soft landing of the U.S. economy. Prospects for extra rate hikes by the Federal Reserve versus speculation of a recession in the next months. Fed's pivot. Geopolitical effervescence versus Russia and China. U.S.-China trade conflict. USD index relevant levels. Now, the index is retreating 0.19% at 100.97, and the breach of 100.82, 2023 low February 2nd, would open the door to 100.00, psychological level, and finally 99.81, weekly low April 21, 2022. On the upside, the immediate hurdle comes at the weekly high at 102.60, weekly high January 31st, seconded by 102.89, January 18th, and then 104.02, 55-day SMA. Gold price forecast, XAU/USD ICE acceptance above $1,960 to initiate a fresh uptrend. Gold price is sitting at the best level seen in the last 10 months above $1,950. XAU/USD needs to take out $1,960 resistance for further upside, FexStreet's Money Meta reports. Tide seems to have turned in favor of gold buyers once again. The 14-day Relative Strength Index, RSI, is probing the overbought territory, suggesting that further upside remains in place for the bright metal. Gold price needs to find acceptance above the immediate resistance near the $1,960 level in order to initiate a sustained uptrend toward the April 2022 high just shy of the $2,000 mark. Any pullbacks from higher levels could see the XAU/USD challenging the previous week's high at $1,949, below which a fresh correction toward the $1,920 region cannot be ruled. Forex today, focus shifts to BOE and ECB as post-Fed US dollar weakness continues. Here's what you need to know on Thursday, February 2nd. The US dollar index stays on the back foot and trades at its lowest level in nearly 10 months at around 101.00 following Wednesday's sharp decline that was triggered by FOMC Chairman Jerome Powell's dovish remarks. The Bank of England, BOE, and the European Central Bank, ECB, will announce the policy decisions on Thursday. BOE Governor Andrew Bailey and ECB President Christine Lagarde will comment on the policy outlook and respond to questions from the press after the publication of official statements. Later in the day, the U.S. economic docket will feature the weekly initial jobless claims and the unit labor costs data for the fourth quarter. The Federal Reserve raised the policy rate by 25 basis points to the range of 4.5 to 4.75% as expected. In the policy statement, the U.S. Central Bank said that inflation has eased somewhat but remains elevated and repeated that the committee anticipates that ongoing increases in the target range will be appropriate. Although the initial reaction helped the U.S. dollar gather strength against its rivals, the currency came under heavy selling pressure during Chairman Powell's press conference. Powell, once again, tried to convince markets that there will not be a rate cut in 2023 but acknowledged that the disinflationary process has started. The chairman also said that if inflation comes down faster than expected, that would play into policy. In turn, Wall Street's main indexes gained traction. The benchmark 10-year U.S. Treasury bond yield declined sharply and the U.S. dollar suffered large losses. Fueled by the broad U.S. dollar weakness, euro to U.S. dollar registered impressive gains and climbed above 1.1000 for the first time since early April. The ECB is widely expected to raise its key rate by 50 basis points following the first policy meeting of 2023. Lagarde delivered surprisingly hawkish comments in December, and market participants will look for confirmation of the ECB's willingness to continue to raise rates to fight inflation. European Central Bank preview: Lagarde needs to repeat her hawkish message. Pound sterling to US dollar snapped a 3-day losing streak on Wednesday and gained more than 50 pips. The pair stays in a consolidation phase slightly below 1.2400 early Thursday. The BOE is also forecast to opt for a 50 bps hike, but investors refrain from betting on further pound sterling for now amid the possibility of the BOE pointing to an end to the tightening cycle on worsening growth outlook. BOE interest rate decision preview: the last 50 bps hike, but not the end yet. US dollar to Japanese yen lost more than 100 pips on Wednesday and broke below 129.00. Bank of Japan, BOJ, Deputy Governor Masazumi Wakatabe said early Thursday that the BOJ must not be complacent as downward price pressures remains fairly strong. Following these comments, the pair stays relatively quiet slightly above 128.50. Gold price capitalized on slumping U.S. Treasury bond yields and surged to its strongest level since April near $1,960 before retreating toward $1,950. Bitcoin surged to its highest level since August above $24,200 late Wednesday but struggled to preserve its bullish momentum. BTC/USD was last seen moving sideways at around $23,800. Ethereum gained nearly 4% on Wednesday and continued to push higher early Thursday. At the time of press, ETH/USD was up 1.6% on a daily basis at $1,670. BOE preview: forecasts from 9 major banks, preparing to gear down. The Bank of England, BOE, will announce its interest rate decision on Thursday, February 2 at 12 o'clock Greenwich Mean Time, publishing the minutes of the meeting and Monetary Policy Report, MPR, alongside. As we get closer to the release time, here are the expectations forecast by the economists and researchers of 9 major banks. The BOE is set to raise rates by 50 basis points, BPS, in February from 3.50% to 4.0%. The vote split, forecasts and Governor Bailey's press conference will steal the show. Danske Bank. We expect the BOE to hike the bank rate by 50 bps. We pencil in an additional 25 bps hike in March, now expecting the policy rate to peak at 4.25% in March 2023. Dovish communication from BOE should send euro to pound sterling higher during the day. TDS. We expect the MPC to hike 50 bps at this meeting, but signal a downshift in the pace of rate hikes as terminal approaches. The vote is likely to be skewed to the downside even more than in December. While we view pound sterling to US dollar as a clear expression of risk sentiment and global growth, euro to pound sterling likely captures some variation of local dynamics between the two currencies. With the shift in terminal rate pricing and relative growth expectations likely to favor the euro, we continue to expect a break of 0.90 in euro to pound sterling in the months ahead. Rabobank. We expect the BOE to start off 2023 with a 50 bps rate increase. It would lift the bank rate to 4%. The vote is again likely to be split in a net dovish way. We still expect the central bank to raise rates to 4.75% by mid-2023, as it seeks to pull out the roots of inflation, but the window for larger 50 bps increments closes soon. The risk remains that very restrictive settings prove too effective in slowing the economy. This would present itself in an even deeper curve inversion. We only expect the first cuts by 2024. Nomura. We expect the BOE to raise rates by 50 bps, which we think will be the final half-point move, reverting to 25 bps in March to reach a peak rate of 4.25%. It is a monetary policy report meeting and the bank will publish new forecasts, expect a lower near-term inflation profile due to falling energy prices, but possibly a higher endpoint than the zero rate published in November. We expect the bank to forecast a less pernicious recession than the near 3% decline in GDP it expected at its last forecast round. These forecasts may be significantly influenced by the bank's annual review of the economy's supply potential. SOC Gen. We maintain our forecast of a 50 bps increase followed by a final 50 bps increase at the March meeting to a peak of 4.5%. Wells Fargo. With recession on the horizon, we believe the BOE will take a more gradual approach to rate hikes. As of now, financial markets are priced for a 50 bps hike and our peer economists forecast the BOE to lift policy rates by 50 bps as well. However, we believe policymakers will take a more measured approach and lift rates by only 25 bps as they are now more focused on protecting against a prolonged recession. Following this meeting, another 25 bps hike in Q1 is likely, and at the March meeting, we believe policymakers will signal an end to their tightening cycle. ING. We expect a 50 bps rate hike for the second consecutive meeting. Still, if we get a 50 bps hike on Thursday, then it's likely to be the last. BOE officials have suggested that much of the impact of last year's rate hikes are still to show through, and cracks are forming in interest rate-sensitive parts of the economy. We expect one final 25 bps hike in March, taking the bank rate to a peak of 4.25%. The key question for Thursday is whether the bank itself acknowledges its work is nearly complete. We suspect it's more likely to keep its options open. Citibank. While there is a strong case for the MPC to hike by only 25 bps, a 50 bps move still feels more likely. With demand now likely stronger, and domestic price pressures still intense, we expect the balance of fear to therefore lean towards doing more sooner, with a deceleration to 25 bps likely in March. Deutsche Bank. We see another 50 bps hike that will take the bank rate to 4%. That will potentially be the last forceful hike in this tightening cycle. Although our view is that services and wages data warrants such a move, the risks are tilted to the downside. We continue to call for a 4.5% terminal rate as inflation pressures remain resilient. Silver price analysis, XAG/USD sticks to gains above $24, eyes multi-month top set in January. Silver scales higher for the third successive day and touches a fresh weekly high on Thursday. The formation of a rectangle on the daily chart warrants caution before placing directional bets. The technical setup, however, favors bulls and supports prospects for an eventual breakout. Silver builds on this week's move up from sub-$23.00 levels and gains some follow-through traction for the third successive day on Thursday. The white metal steadily climbs to $24.30 horizontal resistance during the early European session and moves well within the striking distance of the multi-month top touched in January. Looking at the broader picture, the XAG/USD has been oscillating in a familiar trading range over the past 1.5 months or so. The price action, meanwhile, constitutes the formation of a rectangle pattern on the daily chart and points to indecision among traders. This, in turn, warrants caution for aggressive traders and before positioning for a firm near-term direction. That said, positive technical indicators on the daily chart favor bulls and support prospects for an eventual breakout to the upside. A sustained strength beyond the trading range resistance, around the $24.50 to $24.55 region, will reaffirm the constructive outlook. The XAG/USD might then aim to reclaim the $25 psychological mark for the first time since April 2022. Some follow-through buying has the potential to lift the XAG/USD towards the next relevant hurdle near the $25.35 region en route to the $26 round figure. On the flip side, the $24 mark now seems to protect the immediate downside. Any subsequent pullback might continue to attract some buyers near the $23.50 to $23.45 region, below which the XAG/USD could slide to the $23 level. This is followed by support near the $22.75 region, which if broken decisively will expose the next relevant support near the $22.20 to $22.15 zone.